really hit a bottom or a floor. So what we said you needed for the retail sector to see a sustained rally was inventories clean exiting the third quarter or back to equilibrium as we moved into holiday. And then secondarily, you needed to get clarification that June and July, potentially it was the shift towards travel and leisure. It was also the peak of gasoline prices, as well as some of this excess inventory, that a lot of this was from the supply chain constraints in the front half of the year. So if we had clarification that August and September and moving forward, looking backward, June and July was the bottom, that to me at valuation levels like we're seeing, look, you have a Macy's rallying today, it's off of 3 times EBITDA levels. So some of these retailers that I cover, 200 to 300 basis points valuations below where they were trading pre-pandemic. And the situation, if the inventory is cleaned up into holiday, could actually be clean again.
But then, Matt, on the outlook side of things, they lowered their outlook for the rest of the year. And the reasons they cited in the release is the risk, this is a direct quote, it sees in the continued deterioration of consumer discretionary spending in some of its categories and the level of inventory within the industry, as well as risks associated with a more pronounced macro downturn. So that doesn't really sound like peak inflation to me. That doesn't sound like, an inventory base that's really been completely worked through.
It's an excellent point because when you break down Macy's sales today, to me, the key was in relevant categories, occasion-based, return to work, return to occasion. Those categories were up 8% in the second quarter. The pandemic overhang categories, sleepwear, things that is soft home, things that the consumer over-indexed over the past 2 years, down 18%. So +8 versus -18. You're seeing a clear dichotomy of what the consumer is spending on. When it's relevant, they're there. And then secondarily, on the inventory front, to your point, if I adjust my third quarter for the inventory actions, the markdowns that they're taking on that pandemic overhang inventory, the third quarter earnings would have been exactly spot on with my model today. So it's solely the actions that they're taking in the third quarter to ready themselves for holiday and beyond.
Finally, Matt, gas prices we mentioned earlier today down 70 straight days, but the SPR releases are going to end, and there's some talk about maybe some seasonal effects bring a little more pressure to the consumer in the last quarter or two of the year. To what degree is that going to affect your model as well?
I think what you want to focus on is value and convenience. Value, convenience, and innovation. For me, the winners there would be your discounters. Your dollar stores become a lot more relevant as the consumer is seeking the lowest price as well as the most convenient. I also think best-in-class brands. So for us, Nike, Lululemon, Levi's of the world, I think set up really well. And as we move into 2023 on that value-convenience spectrum, to me, the off-price retailers, TJ Maxx, Burlington, and Ross Stores, I think it's a great setup because I think they are benefiting right now from this avalanche of excess inventory that these retailers, such as Macy's, are actually clearing through right now. So the second derivative is off price as the calendar turns into 23.
Shepard Smith here. Thanks for watching CNBC on YouTube.